So when you become CPAs, you go to the client's field and you ask yourself, are you CPAs? I'm sure you remember your audit procedures by now. Now guys, when we get to the client side, when we get to the field, we break the client's company, the client's operations into a lot of operating cycles. We'll talk about the revenue cycle, the expenditure cycle, the conversion cycle. We'll look at the payroll cycle, investing cycle, financing cycle, lots of cycles that we're going to break the client into. And for each cycle, we're going to do our audit procedures. We're going to ask ourselves, are you CPAs? First, we'll start with the risk assessment procedures. We'll try to analyze the risk in each of these cycles. We'll try to understand the internal control of these cycles and we'll do a control risk assessment on that. After that, we'll get to the P of our RUCPAs where we perform test of controls. And if you remember, test of controls was RIO, where we said we're going to reperform, inquire, inspect and observe. So we perform these procedures around the arcs that the management has in place. We perform test of controls on internal controls put in place by the management. We perform RIO around the arcs. Remember, authorization, recording, custody, comparison and segregation of these duties. So we would test the internal controls that the management has in place. And then we're going to look at how controls look. So if internal controls are good, so when we perform test of controls and we find that internal controls are good, that means we can rely on those internal controls. So our reliance on those internal controls would increase. That means control risk would be low. And we can afford a higher level of detection risk. So if control risk is low, we can afford to have a higher level of detection risk. That means we're going to do less substantive testing. So guys, once again, we are looking at test of controls. We are doing RIO around the arcs. There, we want to see whether the client has good internal controls in place, whether those internal controls are able to prevent misstatements coming out of the financials, or are those internal controls at least able to detect and correct misstatements that come in here. So that is when we are looking at the controls that the management has in place. So we do RIO around the arcs. Now, after this test of controls, we assess the results of these controls. We want to see whether our internal controls good. Can we rely on those controls? If yes, we would say control risk is low. That means risk that the client's internal controls will miss a material misstatement is low. If the controls are good, naturally there's a less probability of having misstated numbers here. That means we as auditors, we can afford to do less work. So if internal controls are so good, we think the financials are going to be correct and we'll do less work around these financial statements. We'll do less substantive testing. But if internal controls are not so good, they are bad internal controls. So let's say if internal controls are bad, that means the control risk is pretty high. And we as auditors, we need to keep the detection risk low. Control risk high means the probability of misstatements coming out of this financials is pretty high. That means we cannot miss any misstatement. We as auditors, we need to do more work. Substantive tests need to increase. So I've given this to you again and again, and this is very important for you to understand your audit procedures. So substantive testing, I've given you the mnemonic for substantive testing, remember? So we said RIO for test of controls. For substantive testing, it's more than that. It's RIO car race apps. So it's RIO plus more, RIO plus car race apps. We've talked about RIO, but we look at car race apps when we get to audit 4. So in substantive testing, the auditor is doing RIO car race apps around the management cover up. Now cover up are the assertions by management. So when management gives us these financials, they make certain assertions. Management says cover up. So basically we're saying management is trying to cover up the numbers. Now we as auditors, we do RIO car race apps around this cover up. Test of controls, we are doing RIO around the arcs. Substantive testing, we talk about that in audit 4. We'll do RIO-CARA-RIS apps around the management cover-up. If internal controls are good, that means our test of controls said internal controls are good, we'll have to do less substantive testing. But if internal controls are bad, we'll do lot of substantive testing, lot of test of dollars on these financials. We'll do more RIO-CARA-RIS apps around the management cover-up. Let's now start looking at the operating cycles that we break the company down into, and we'll do RIO around the arcs for each operating cycle. This is our focus in audit 3. Again, when we get to audit 4, we'll look at substantive testing. On page 23, we're starting to look at operating cycles. Now, few considerations when we look at the operating cycles would include highlight segregation of ARC, that's authorization, recording, custody, and comparison. Highlight PPN, so documents need to be pre-numbered, pre-printed, and in a numerical sequence. Right? Cash is equal to increase in inherent risk. So wherever cash is involved, IR would go up. Basically, the RMM would increase. We're going to be looking at highlight preventive controls, which highlight prevent misstatements from occurring, and highlight detective controls, which highlight detect and correct misstatements after they've occurred. Let's start with first looking at the revenue cycle. So revenue cycle is where the client is making sales to its customers. So it's sales to accounts receivable, and then they get in cash. So it's cash receipts from their customers. So guys, when we look at the revenue cycle, it's got cash receipts. The word cash, does it ring any bells? Yes, cash means high inherent risk. Cash is highly susceptible to theft. There might be employees of the clients misappropriating the cash. So that means that they need to put in strong controls to reduce the control risk and their risk of material misstatement. Even when we're looking at the entire cycle, even sales, that's sales of inventory. Even inventory might be susceptible to theft depending on the kind of inventory the client has. Let's say if it's a diamond merchant, the diamonds could be stolen. If it's pens, maybe. So we are looking at making sure what kind of controls the client has on these revenue cycle. So let's try to understand how this cycle looks. If you look at our auditor's perspective, we are doing RUCPAs on this cycle. So we start with our risk assessment procedures where we first try to understand the internal controls here, and we document whatever we find. Remember the F of a find, that was flow charts. So we'll use that in trying to understand how the internal controls look. After that, we would perform test of controls. We would do RIO around the arcs on this cycle. So first, let's understand the structure of this cycle. So let's say the client gets purchase orders from its customers, which goes into the sales department at the client. So let's say customer purchase order going into the sales department at the client. Now, sales department is generally required to generate an internal sales order. So they would have an internal sales order. So basically, customer purchase order is now converted to an internal sales order developed by the company. Now the purpose of having an internal sales order is you could have it numerically controlled in a numerical sequence. So you could have sales order starting from sales order number 1 to whatever numbers you're getting the sales order. So it would be pre-printed, pre-numbered, and in a numerical sequence, numerically controlled. Now this sales order would then go to the credit department. So it would go to the credit department, which would authorize credit. The credit department would say whether this customer deserves to get a loan on credit. Is this customer's credit good? Is it credit worthy? And then this becomes an approved internal sales order. So the same internal sales order is signed off by the credit department. They stamp it, they sign it, and it becomes approved. Now this approved internal sales order goes to various places. So let's start with the warehouse department. So warehouse is a place where all the goods are stacked up. This internal sales order also needs to go to the shipping department. So shipping department is the department which ships out goods to the client. It would also need to go to the billing department. Let's say billing and accounts receivable departments. So you could have two different departments or one department. So billing department, as the name says, it generates the bills, the invoices which is sent out to this customer which has given the order. And then it also goes to the accounting department. Accounting department would update the general ledger so that the numbers come on these financial statements. So you have this approved sales order going across the company. So let's say the warehouse department which gets the internal sales order, depending on what the order is, they would pick out goods from the lots and push it to the shipping department. So they'll have the goods which they would push to the shipping department. Now, the shipping department would then send these goods out to the customer. So the customer who placed the order here is now receiving the goods from the shipping department. Now, when the shipping department sends out goods, they could send it out by, let's say, by road, by rail, by sea, by air, and from the carrier, the shipping department would receive a document which is called the bill of lading. So they would get the bill of lading which they would send to the billing and accounts receivable department. Now the billing department would then generate a sale invoice. Try to understand. So the billing department has an approved internal sales order which has come in from the sales and the credit teams, and they have the bill of lading. So before generating the sales invoice, they would want to check, did the customer place an order for these goods? And if yes, did the goods sent out by the shipping department on the bill of lading, does it match with what the customer placed an order for? And then they would generate the sales invoice which they would send to the customer. Now, when the shipping department sent out goods to the customer, they could have sent out a packing slip along with the goods, so that would have mentioned what the goods, what the cartons, what the lot contains. Now, so the packing slip would contain the customer's name, the type of goods ordered, the quantity of goods ordered, but it would not have contained the price for the goods, the total amount for the bill. So that would be the packing slip which along with the goods that the shipping department would have sent out. Now, the billing department, they put the price. They put the quantity, the price, the total amount, and then they send it out to the customer that these are your goods and that's the invoice for the goods that you've received. This invoice could be sent along with the goods or it could be sent separately by courier. Now, the sale invoice that the billing and accounts receivable department have then go to the accounting department, who then update the general ledger, and the numbers flow into the financials. So basically, if you think it's accounts receivable debit, sales credit, so that's what's happening. So sales and accounts receivable, both the numbers get updated on the financial statements. So that's what the accounting department does. So guys, this is how the revenue cycle looks as far as the sales are concerned, sending out goods to the customers. Let's look at this, what each department is doing. So when you look at the sales department, what is it doing? It's authorizing that yes, goods should be sent to the customer. So it's doing authorizing A of our ARCs. Remember, management is responsible for putting this in place. Here, we as auditors, we are only trying to understand how it looks. So we have the sales department doing authorization, the credit department doing another level of authorization. The credit department is authorizing the credit of this customer. Then it goes to the warehouse. The warehouse guys, they have custody of the goods. They have the goods piled up with them. Shipping department, so warehouse pushes to shipping, shipping sends it out. These guys also have custody of the goods. Billing and accounts receivable department, they are doing the record keeping job. They're making sure that yes, goods are sent out, so it's now time for us to send the invoice to the customer. So billing guy sends the invoice, the accounts receivable department, they update the accounts receivable master. And then you have the accounting department, which again do record keeping by updating the general ledger. So the customer placed an order here, received the goods, the bill of lading, a copy of the bill of lading, and the sales invoice. So that is the goods being sent out to the customer. Let's look in the book and we'll come back and look at cash receipts back from the customer. Where we're looking at a flow chart for sales and billing cycle. So we have it starting from the customer purchase order, which goes into the sales department, which then generates an internal sales order. So the job of sales department is the A of our ARCs right there. A, that's authorization. The internal sales order goes to the credit department, which then authorizes credit. Fill a A on the bubble there. Now this approved internal sales order goes to warehouse or shipping, goes to billings and accounts receivable, goes to accounting. Let's look at warehouse and shipping. They've got custody of the goods. Write a C on the bubble. So they send out goods to the customer, get back of bill of lading, which is sent to billing and accounts receivable departments. Now coming to billing and accounts receivable, they are the record keeping function. Write an R there. Now they send a copy of the sales invoice to the customer. They update the accounts receivable master, update the sales summary and sales journal. All this information goes into the accounting department, which again is responsible for, write a R there, updating the general ledger so that the numbers come to the financial statements. Then you may have an internal audit department which does periodic reconciliation between what has been done by the billing and accounts receivable department versus the accounting department. Write a C2 on the bubble there. That's the second C of our ARCs comparison. We just saw that our client received a purchase order from the customer and they shipped out goods to the customer, send them an invoice. Let's say our client is Reynolds and they received an order for 10,000 pens at, let's say, $1 to each pen from one of their customers. The sales team received that purchase order, generated an internal sales order for the same quantity, same rate, and making sure they mention the type of pens they want. So let's say they want black pens, red pens, blue pens. They could mention all that on the internal sales order, which then gets approved from the credit department. So the credit department says this customer's credit is good. You can supply goods to them. This approved sales order goes throughout the company. It goes to the warehouse department, which pushes the 10,000 pens to the shipping department, who then ship it out to the customer. So the customer gets the 10,000 pens from the shipping department. Along with that, they get a packing slip which mentions 10,000 pens of whatever color, red, blue, green. But the packing slip does not contain the price for this 10,000 pens. That comes in from the sales invoice. So let's say the billing department raised a sales invoice. Let's give it a number. Let's number it 77. So sales invoice number 77 for 10,000 pens at $2. That's $20,000. So $20,000 invoice which gets sent to the customer. Now, let's say the customer sends back a check for this $20,000 against sale invoice number 77. So you have this customer check coming in. Now guys, this is a check for $20,000. Now you want to be sure that this check that comes in from the customer actually gets deposited into the bank. Nobody's stealing this. Nobody endorses this check in their favor. The employees of the company, they're not misappropriating this. So this comes into the mail room. It comes in by courier to the mail room. Now along with the check, so it will be a check for $20,000. The customer would often send in a remittance advice. On the remittance advice, the customer is going to mention they're giving $20,000 against, let's say, invoice number 77. So it'll be $20,000 of check against invoice number 77. So this was the invoice which was raised by the client to the customer. So this remittance advice is the details against which the check is issued. Now, if you look at the mail room, they would get a lot of checks through the day, right? From morning till evening, let's say they got 10 checks during the day. So at the end of the day, they would prepare something what we call a pre-listing of the checks received during the day. So pre-listing of checks. Now the check goes into the cashier, who deposits it onto the bank. So you have the mailroom sending this check to the cashier, who would deposit into the bank, get something called the deposit slip. The remittance advice which the mailroom received. So the mailroom receives checks and remittance advices. They separate them. They separate the bundle of the 10 checks received during the day and the 10 remittance advices received during the day. So this remittance advice goes to the accounts receivable department. A copy of it can also go to the accounting department. Now, if it's a big company, they would have a separate accounts receivable department to update the accounts receivable master, a separate accounting team to update the general ledger. A small company could have one team doing both these jobs. So they get the remittance advice from the mailroom. Now, let's say 10 checks received during the day. Along with the 10 checks which the mailroom sends to the cashier, they also send a copy of the pre-listing of checks to the cashier, so that the cashier can compare and make sure that he's actually received all the 10 checks which are listed on the pre-listing by the mailroom. A copy of this pre-listing is also sent to the accounts receivable in the accounting departments, so that they can make sure that they have received all the remittance advices for the 10 checks which are there on the pre-listing of these checks. Now, let's say one of the customers does not give a remittance advice. They just send in the check without giving any details of against which invoice they had given the check. In that case, the mailroom themselves can prepare this remittance advice. So the remittance advice generally comes in from the customer. If the customer sends only the check, not the remittance advice, the mailroom can prepare the remittance advice. Now the mailroom guys, they will not know against which invoice the check has been received. So on the remittance advice, they would just mention that they have received it for, let's say, $20,000 or whatever amount. So if it comes from the customer, it will be pretty detailed. If the mailroom prepares it, it might just have the amount and the check number. Now, the deposit slip. So the cashier receives the check, deposits onto the bank. This deposit slip is then forwarded by the cashier to the accounting team. Now, if you look at it, the mailroom, they have custody of the checks. The checks come in from the customer first to the mailroom. The cashier, he's also got custody of the checks. How do we make sure that this cashier who's got the checks, he does not pocket the cash, he does not endorse the check in his favor and take home the cash? That is why we have a separate recording team. These guys make sure that they update the accounts receivable master, the general ledger, as per the remittance advices that they get. So if a check is not deposited into the bank, we will have a separate bank reconciliation done by an internal audit team. So internal audit team would do a bank reconciliation to try to make sure all the checks that have come into the company have been actually deposited to the bank. So this is going to the bank. So they would do a bank reconciliation. You got to make sure nobody is stealing away the cash. So if you realize there's custody, record keeping, and this internal audit team, this is C2, or you could call it comparison. So you had ARCs, authorization, recording, custody, and comparison. So this was the cycle where the goods were sent out to the customer and now the checks are coming in from the customer. Now, there might be a case where certain customers default. They don't pay, they don't give back the checks. It's a bad debt. Now, whom do you want to be authorizing the bad debts? Do you want the cashier to authorize the bad debts? In that case, what he could do is, he could receive the check, endorse in his favor, and then authorize that it's a bad debt. You certainly don't want that to happen. You want a separate guy doing the authorization for bad debts. So generally you have the treasurer of the company who's authorizing the bad debts. Now we don't see the treasurer anywhere here, right? Because he is separate. Generally the treasurer is responsible for making payments out to vendors. We will see that in the expenditure cycle. So the treasurer would authorize the bad debt. The credit team would also come in and make sure that they're aware of the bad debt so that they don't approve another credit to a customer who does not pay back to the company. And then the treasurer's authorization for bad debt goes to the accounts receivable department and the accounting department, who update the records that yes, we did not receive the check, it's a bad debt, the company did not get the payments back for the goods that they had sent to the customer. So this is the major cycle where we're looking at sending goods out, receiving checks. If we don't receive checks, if it's a bad debt, it needs to be properly authorized. You can't have the guy who is having custody of the cash doing authorization, because they could simply pocket the cash and say it's a bad debt. So guys, this is the arcs in the revenue cycle that management needs to have in place. Remember, management is responsible for internal controls. They need to have the crime, the 5 components in place. The very important part, the E of the crime, that was existing control activities, the arcs. Then we as auditors, when we step in, our job is to understand how these controls look. So we might do a flow chart to try to understand how the internal controls have been placed by the management. And then we would perform a test of controls around these internal controls. We'll look at that after we understand this from the book. Let's look at the flowchart for cash receipts. So you have the customer check and remittance advice coming to the company. It first goes to the mailroom, who've got custody, right to see there. So the mailroom gets customer checks and remittance advices. They segregate them. They also prepare a pre-listing of checks. Now the check from the mailroom, that goes into the cashier, who's again having custody, right? See there. The cashier also gets a copy of the pre-listing of checks which the mailroom has prepared. The cashier deposits the check to the bank, gets a check deposit summary which it forwards to accounts receivable. The accounts receivable is also getting the remittance advices from the mailroom as well as a copy of the pre-listing of checks. These are the record keeping guys, right? Are on the bubble there. They update the cash receipt summary, journal, and send it to the accounting department, which is again record keeping, right? Are on the bubble there. Now the company may have an internal audit department to make sure of periodic reconciliations, bank checks, that's comparison, the second C of our arc. So write C2 on the bubble there. Moved on the page and we're looking at a flowchart for write-offs. So write-offs are initiated by the credit department as per the debtor aging schedule. So these guys are responsible for A, authorization. Then it goes to the treasurer who approves the write-off. Again, that's authorization. The approved write-off goes to accounts receivable and accounting. Put R and R on the two bubbles there because both these are record keeping functions. On page 27, we're looking at sample arcs in the revenue cycle. Highlight sales or billings. Highlight segregate authorizing sales, recording sales, and custody of inventory. And it's also important to highlight segregate the authorization of sales, which is by the sales team, from authorization of credit to customers, which is by the credit department. Right? Sales department, they get variable pay. So the more they sell, the more they earn. Versus credit department, they get a fixed pay irrespective of the amount of sales. Highlight sales discount. So there need to be proper sales discount procedures to ensure proper approval and record keeping of such discounts. highlight cash receipts. Now for cash receipts, need to highlight segregate recording cash receipts and custody of cash. The entity may highlight bond employees who handle cash, such that the insurance company which bonded the employee would cover the loss in case of employee theft. Now, entities may also eliminate employee access to cash by using highlight bank lockbox services. For highlight write-offs, need to ensure that highlight cashier who's got the custody of cash is not responsible for authorizing write-offs. Otherwise, right, bad debt could mean employee stole cash. For highlight sales returns, when we talk about highlight custody of sales returns, it should be by the receiving department who should issue a pre-numbered receiving report for each sales return. Highlight the cashier who's got the custody of cash cannot be responsible for authorizing credit memos. Now on page 28, we got management assertions, and we're going to spend a lot of time talking about the management assertions of cover up in audit 4. But let's have a quick preview for a couple of assertions which we spent quite some time talking about. So the first one, completeness. And we know for the completeness assertion, we trace as auditors. When we talk about the completeness assertion, management is trying to assert that highlight all sales that should have been recorded, highlight have been recorded. Next, highlight existence or occurrence assertion. And the auditor highlight vouches to test for existence. Now, for the existence assertion, management is trying to assert that highlight all sales that have been recorded have actually occurred. So we've been talking about management responsible for internal controls. Management is responsible for putting the arcs in place. Then we as auditors, we step in. We first understand how the internal controls look at the form of these internal controls, and then perform test of controls around these controls. We perform RIO around the arcs. So in the revenue cycle that we've started with, we've looked at the sales cycle, where management has authorization, recording, custody, and different teams doing these jobs. We come in, we understand how these internal controls look. We can do a flowchart as we have done here. We can do it as an internal control questionnaire. So we can go to the management and ask them, when customer purchase orders come in, do you generate an internal sales order? When you generate an internal sales order, does it go to the credit team for approval? When the credit team approves the internal sales order, does a copy of that go to warehouse? Does a copy of that go to shipping, to billing and accounting? So we want to make sure, we ask the management then, when the warehouse receives the approved internal sales order, do they push the goods to shipping? When shipping receives the goods, do they check with the sales order before shipping out the goods? When shipping gets in the bill of lading, do they send a copy of that to the billing department? Does the billing department raise a sale invoice for all the bills of lading that they get, and do they send out the sales invoice to the customer? Then does the accounting department update the general ledger when they receive a copy of the sale invoice from the billing department? So it could be as a flow chart as we've done here, it could be as an internal control questionnaire, it could be as a narrative, it could be as a decision table. So we as auditors, we understand the internal controls, document whatever we find. Even in the cash receipt cycle, so we understand the internal controls, we understand where the management has put the arcs in place, whether they have different teams doing authorization, recording, so recording, custody and comparison, and segregation of duties, naturally different teams. Now, after we understand the internal controls, so if the form of internal controls looks good, then we decide to perform test of controls. And as I've told you again and again, we do RIO around these arcs. So as auditors, we do REO around ARCs. So we could say auditor, that's REO. So we have RIIO. Now R is re-performance, inquiry, inspection and observation. So you have the internal controls already in place by management. Remember, it's the management's responsibility. Our responsibility is to come in and see how those internal controls are. So now we'll do REO around the ARCs placed by the management. So let's do REO around these cycles. So the sales cycle. So when we want to look at the sales cycle, we want to look at the ARCs of the cycle. Let's start with the R of our REO, re-performance. So we might want to re-perform the credit check that the credit department does. So something like we get into the credit department and we redo whatever the credit department does, re-perform. We are trying to redo what they are doing. So we check what's the database they are referring to. Do they have DNB reports? Do they have customer track records, customer history before they give credit approval for that customer? So we do re-performance of the credit procedures. We might want to re-perform billing. So when we get to the billing department, we want to see when we get the bill of lading from the shipping department, we get the approved sales order from the credit department, then the bills are prepared. So we re-perform, we do what they have been doing and see if the results match. Let's talk about the first I of our REO, inquiries. We might want to go to the credit department and inquire how do they do the credit check. We might want to go to the shipping department and inquire, do they send out before sending out the goods, do they check with the approved internal sales order whether the goods need to be shipped out? Do they send out a packing slip? When they get a bill of lading, do they send it to the billing? So this is inquiries. We are asking the entity personnel. The second I of our REO, inspection. So we might want to inspect documents. Let's say we want to inspect the sales invoices in the billing department. Now inspection, you remember, tracing and vouching. So when we trace, we might want to start from the customer purchase order, get to the internal sales order, approved internal sales order. Then we might want to look at the bill of lading and then the sales invoice. We are tracing in order of preparation for completeness. Or we might vouch. Vouching is we start from the sales invoice and then we look at the relevant bill of lading and then we look at the relevant approved internal sales order. Then we look at the relevant customer purchase order. So that's vouching in reverse order. So tracing is in order of preparation. Vouching is in reverse order. So we'll do that again on that part of the board. So that was inspection. Now, so REO was the O of a REO, that's observation. So observation is when we hide and we want to check. So let's say we go to the warehouse department, we hide and we see whether they're pushing goods to the shipping department. We go to the shipping department, we hide there and see what they're doing. Do they send out goods to the customer and when they get the bill of lading, do they send it to the billing? We might want to go to the billing department and then hide there and see whether the billing department actually checks with the internal sales order and the bill of lading before raising invoices, or they just send invoices to customers without even being sure that goods are actually sent to them. Think about it, right? As a customer, if you get an invoice without getting the goods, you'll be very angry. So you want to make sure that they have the right kind of controls in place. So that's REO around the ARCs, where we make sure whether the controls are good or they aren't good. Can we rely on those controls or shouldn't we rely? So that was the REO around the ARCs. So this was REO on the sales cycle. Let's look at our REO, the auditor's REO on the cash receipt cycle. So let's say we are looking at the customer checks coming to the company and then going to the bank. So we might want to do our REO around these ARCs. So we'll do re-performance. Let's say we re-perform the bank reconciliation that's happening here. So the internal auditors, they do the bank reconciliation. They want to make sure all the checks received by the company have been deposited to the bank. Now we might want to do the same thing. We might want to see whether actually the internal auditor is doing the right job. Then you have the I of a REO, inquiries. Let's say we go to the cashier and we inquire, we ask him, how do you do stuff? What are you actually doing? When you deposit the checks into the bank, do you prepare a deposit slip? Do you send it to the accounts receivable guys? We might want to inspect. Let's say we want to inspect these deposit slips. We might want to inspect this bank reconciliation. So that's our inspection, the second I of our REO. Observe. Again, let's say we go to the mail room. We hide there. Again, we hide and observe. We look from our own eyes whether when they get in mails, they open the mails, do they segregate the checks and the remittance advice? Now, for all the checks that they receive during the day, do they prepare a pre-listing of checks which is sent both to the cashier and to the accounting teams? So we want to observe, we want to see it with our own very eyes, hide and see. We might want to go to the cashier again, hide and see what's he doing. When he gets the checks, does he deposit the checks onto the bank? Does he prepare deposit slips which is sent to the accounting team? So we want to make sure we use these procedures to check how good the controls are. So guys, we are performing a RIO around these arcs. Again, the re-performance, our re-perform. We do what the client is already doing, what the entity personnel is already doing. We do it on our own. Inquiries, we ask them. Inspection, we see what they have already done. Observation, we see it while they are doing it. So guys, re-performance, inquiries. So we have re-performance, inquiry, inspection, and observation. These are our tools to test controls. And as we know, inspection could be tracing or vouching. So we have vouching or tracing. Now tracing, the T was like this, remember? So let's do it on this cycle. So let's look at all the documents that we have. So the documents that start with, let's say, the customer purchase order. So the client gets purchase orders from its customers. Then you remember, they generate the internal sales order. So you have the sales order which is then approved by the credit team. After that, goods are sent out and the shipping department, they get a bill of lading. Exactly. Then this bill of lading gets sent to the billing department. And what do? They raise the sale invoice. So the sale invoice comes in next. Then the sale invoice goes to the accounts receivable, accounting department, who then update the accounts receivable master and the general ledger respectively. So then it goes on to the journals and let's say the ledger, which then flows into the trial balance. And then finally you have these financial statements in place for all the sales that have happened, all the transactions, all the balances. So you have the financial statements coming in at the end. So vouching means whenever you're moving from any of this towards the bottom. Tracing means whenever you're starting and going upwards. So we are saying you vouch in reverse order for existence. Trace in order of preparation for completeness. So let us say the auditor starts with a bill of lading. So he looks at all the bill of lading, all the shipping documents, and then he traces it to the sale invoice. So he wants to make sure for all goods that are sent out to customers, has the company raised sale invoices for that? So he wants to check whether the sales figure that they have on their financials here, is it complete? That means all sales that have happened, have they been recorded? You getting it? So all bill of lading that was sent out, has there been an invoice raised for that? Naturally, think of it, the client is never going to miss it. But still, we need to be sure whether they are doing the right job there. So for all bills of lading, has there been a sale invoice which then goes to the journal ledger, trial balance, and then flows into the financials. So that's tracing in order of preparation for completeness. So all sales that have happened, have they been recorded? Then let's look at reverse order. See, vouch in reverse order for existence. Now you're looking at all sales that have been recorded, have they actually taken place? Understand the difference between completeness and existence. Completeness is all sales. So all sales that have happened, have they been recorded on the financials? So financials are on the top here, right? So all sales that have happened, have they been recorded on the financials? That's completeness. Existence is all sales that have been recorded on these financials, have they actually taken place? So when you're doing existence, you're vouching in reverse order for preparation. Let's say you're vouching from the financials and you're going down to the bill of lading. Or you could vouch from sale invoice, go to the customer purchase orders, the way you want it, basically depending on your audit objectives. But whenever you're going in reverse order, you're vouching. whenever you're going in order of preparation, you're tracing. You trace for completeness. You vouch for existence. Guys, get it onto your heads. Get a lot of questions on this, and trust me, if you know this concept, those are goodie marks for you. Now, let us actually, so we do RIO around the arcs. Now, when we get to the next audit chapter, the audit 4, we'll look at RIO car race apps. So this RIO is test of controls. RIO car race apps, that's substantive testing. So here we are doing RIO around the arcs. Then we'll do RIO car race apps around cover up. So we will have cover up there. So cover up is what? The management assertions. Now, often we start with looking at management assertions even from this test of controls phase. They are often tests called dual purpose tests. Tests which are not only test of controls but also substantive testing. So that's where management assertions come into play. So if you realize, even when we are looking at test of controls, we might want to do substantive testing together to save time, to be more efficient with the audit. So as I told you, we may vouch in reverse order for existence. This existence, this is the E of a cover up. Trace in order for completeness. This is the C of a cover up. So I'll give you a quick review on this cover up once again, but we'll talk about this in detail when we get to audit 4. So cover up, the C of cover up stands for completeness, as I told you. So if you have the financials here, all sales that have happened, have they been recorded on the financials? That's completeness. Existence, all sales that have been recorded in the financials, have they actually taken place? So you're getting the two different ways of questioning. So that's completeness and existence. The O of our cover up, that's cutoff. So cutoff means, let's say December 31st is year end. You want to make sure that management records sales in the correct period. We don't want them to record sales of the next period in the current period. So that's cutoff. V is valuation. So do they have, V is valuation, allocation and accuracy. Have they accurately recorded sales? Does the valuation of accounts receivable here, is it right? So let's say when you're looking at valuation, we want to be making sure that have they rightly recorded the allowance for uncollectibles, the allowance for doubtful debts. So that would be a valuation question on accounts receivable. So you have accounts receivable less allowance for uncollectibles. So that's the valuation assertion for management. If you realize management, when they give us this financials, they are making these assertions. So management is telling us auditors that everything here is complete. So everything that's happened has been recorded. They're telling us it's cut off, right period. Everything here is right valuation, right accuracy. Everything here actually exists. All transactions here have actually occurred. So management is giving us those assertions. They are saying they have rights and obligations. So in this cycle, let's say the management is telling us they have rights to collect the accounts receivable that they have on these financials. U is understandability and classification. They've put it under the right accounts, presentation and disclosure. So let's say in this cycle, management may say that they have disclosed all related party sales, all sales to employees. That could be important. So if you understand, these are management assertions which management is making as regards these financial statements. Now, we are doing test of controls where we are not specifically looking at these dollar numbers, but yeah, that's there in the back of our mind, because after doing test of controls, our next step would be, our next further audit procedure is going to be substantive testing, which is compulsory. Now, depending on the results of this test of controls, we might want to increase or decrease the nature, the extent and timing of substantive tests. We'll come to that. So guys, make a nice understanding here. We are doing RIO around the arcs. Then when we get to substantive testing, we'll get to doing RIO car race apps around the cover up. So I just want you to get back to the dashboard and understand this concept here very well. So we have management responsible for internal controls. Auditor does RUCPAs. So that's the summary of our audit procedures. First, risk assessment procedures. We come in, we understand internal controls, understand how the controls look at the form, document whatever you find. So we have documented as flowcharts here. Then we get to P, the test of controls. So we do RIO around the arcs. Depending on how good or how bad the controls are, we might want to do less or more substantive testing. Substantive testing is going to be RIO. That's RIO we are already doing here. Re-performance, inquiry, inspection, observation. RIO plus a little more. Car race apps. And we would do this around cover up. Rio is around arcs, Rio car is apps, that's again cover up. Guys, I'm sure, just fit this onto your head and you'll have a great time when you become auditors. Let's get to the book, look at this cycle, and then we'll come back again with the expenditure cycle. On page 29, we've got a lovely table which talks about the test of controls relating to sales. So the first column, you got the various departments and the employees. The second column talks about the documents which come into the department and go out of the department. The third column has a few sample controls which are to be placed by management. And we know that, right? Management, they are responsible for arcs. And the last column talks about the sample test of controls by the auditor. So right there, auditor equals Rio. So guys, the auditor is using Rio to test controls, to test the arcs which are placed by the management. This is a pretty good table with a good sample of controls by management and the test of controls by the auditor. And I want you to review this on your own. Turn to page 30, where we have another table talking about test of controls relating to cash receipts. And on the column where we have the sample controls to be placed by management, right? Management equals arcs. On the column where we've got the sample test of controls by auditor, right? Auditor equals Rio. Again, another pretty good table which I want you to review on your own.